Welcome to Inside Economics. I'm Mark Sandy, the chief economist of Moody's Analytics, and I am joined by a number of folks. So let's just introduce the lineup. We got the regulars, my two co-hosts, Ryan Sweet and Cris Dorides. Hi, guys.
Mark.
Hey, Mark, I'm proud of Cris. He's getting used to this casual look now.
Oh, I wore a black T-shirt in honor of a Black Friday here. So yeah.
There you go.
Black Friday. Oh, you're talking about the stock market.
Yeah. Well, markets in general, right?
Yeah, markets in general. We got to come back to that for sure. But yeah, he does look a little casual. But no matter what Cris wears, he looks good. Have you noticed that, Ryan?
Yeah, he dresses and tries to be. He wants to be the first economist on the cover of GQ.
Is that a possibility?
I doubt it, but
is
always
GQ still a magazine?
Mark, haven't you been on there already?
Oh, actually, I got a great story.
I knew it.
I got a great story. Let me introduce the other two guests, okay? Before I tell you the story, because you absolutely will not believe it if you're watching this on YouTube and you see my hairline, but I'm going to tell you anyway. We got Janice Stanton. Janice is with Cushman Wakefield. Good to have you, Janice.
Good to be here, Mark.
And Janice and I think we go back. I'm not going to even say how many years.
I think we were one of your first clients, and we take full credit for recognizing the brilliance early on, right?
That was a great, I can't remember what the project was, but I just remember it was a great project. I don't know, I have this warm, fuzzy feeling about this project I did with you. Was it a good project? I can't even remember.
Yeah, it was risk-adjusted cap rates with Susan Wachter and, like professors and real estate and...
Yeah, with Susan Wachter, of course, who's a well-known real estate professor at Wharton, University of Pennsylvania, and a good friend, too. I don't think we've gotten her on the podcast, but we definitely should get her on the podcast.
Yeah, absolutely.
Yeah. And, that was my first first time I crossed paths with Susan, too, I think, in that project. That was interesting. Yeah.
And Mark, was your reaction, what? How do you guys measure cap rates? Really?
Yeah, right. Something to that effect, I think.
Yeah, it was like, why is the data so bad?
Yeah, what's going on there? And of course, you heard the voice of Victor Calanog. Victor, how are you?
Good, Mark. Thanks for having me today.
And actually, I'll have to say, Victor, you look better than Cris. I don't know what you guys think, but man, he looks really sharp. Yeah.
I was gonna go for the cover of Muscle and Fitness, but that would mean less clothes, I think, than we would allow.
Okay, let's not go there.
Let's not go there. Let's not go. Oh, the obvious. Janice and Victor are experts in the commercial real estate world, and we're going to obviously do a deep dive here into the CRE world. A lot going on there and a lot to contemplate, both in terms of what it means for the CRE market, but what it means for the broader macroeconomy. But before we do that, we do need to talk about what's going on in markets. I wanted to tell you the story, though, because actually I'm somewhat proud of this.
Do you still have it framed? Do you have it framed? Because I know what story you're going to tell.
Probably in that office I don't really use. So
okay.
It may be there. So I was in Fortune magazine as one of the sexiest economists in the world. I'm not kidding. And this is like 30 years ago.
That is a pretty low bar.
Yes, that's what I said. That is so true. That's what I said. I go, really? I remember I can't remember who they had, like 3 or 4 or 5 economists. So that's when I had some muscle mass, Victor.
You should be proud of that. 2 words that don't ever go together: sexy and economist. So
that is so funny. Anyway, that's my claim to fame. Let's talk about the markets. And Cris, you want to give us a sense of things? I mean, what markets are doing, why, and what potentially the implications are?
I believe the term you used earlier was markets are losing their mind. And I think that's pretty apt.
Hair on fire.
Hair on fire, right? So all over the place, it seems as though investors are selling assets, right? So the stock market is down, S&P 500, Dow Jones, take your pick. They're all down. Bond yields are up, right? So people are selling off their bond assets as well, or requiring a higher yield. So there's a general risk off approach here. Fear all around of recession. The most obvious trigger, of course, is the Fed's statement earlier this week. Fed action of 75 basis points, a hike was well known, well communicated. So I don't think that was the reason why folks are taking on this attitude. It's more the statements and the dot plots that Ryan will certainly get into, indicating that the Fed certainly has a more pessimistic outlook here, suggesting that rates will be higher for longer, making that very concrete. I think if you've been paying attention, you've noticed that Powell has been very hawkish, but now he's really trying to send that message over the banister to everyone in the marketplace. And I think finally folks are taking the message to heart. You also have geopolitical risk, of course, with Russia, Ukraine still percolating, escalating perhaps as well with the call up of Russian reserves. So lots of things to be fearful of all the way around. So I think that's what's going on in the marketplace today.
Yeah, Janice, what is your official title at CW?
Executive Managing Director, Capital Markets.
Capital Markets. And so you're looking at the CRE market, the commercial real estate market, through the prism of capital markets, debt and equity capital that drives investment in CRE all over the world. In fact, we've been trying to get you on this podcast for a long time, but every time we think we've got you nailed down, you're in some other part of the world, which we'll come back to. But is the capital markets, CRE capital markets, as in turmoil as every other market appears to be?
It's not great. I felt a lot better, frankly, before Cris went through that litany of things going on today. But I think what we're seeing in the commercial real estate markets is the fundamentals are actually pretty decent. But because of what's going on in interest rates, and if you're a borrower, and most people who buy commercial real estate are levering, not only are your LTVs are down, but based on everything else Cris is talking about, your borrowing costs are up a couple hundred bips. And as a result, people have kind of pushed to the sidelines. I mean, August trades are down 40% year over year. And that's after a great first half of the year, because people are just trying to absorb what's going on and then figure out what they want to do right now. So there's definitely been, kind of a dislocation of the market. But what's happening, unlike where you always get trades in the stock market or in the bond market, you're getting a bid-ask spread. You're getting a 10 to 20% bid-ask spread, where some of the sellers are going, you know what, I'm going to wait it out and see what happens. So more than anything, there's a lack of transparency, which is funny because when you read the reports, someone will say, oh, cap rates are down. And you're like, what? Because it's just the transactions haven't necessarily cleared the market in that specific property type or location. But everyone is feeling the pinch of higher borrowing costs.
So let me just translate that a little bit to the listener. So my translation of some of what you said is the market is the capital flowing into the commercial real estate market is gone to the sidelines. The investors have gone to the sidelines because of this broader turmoil in markets, the Fed tightening, the run up in interest rates, both short and long-term interest rates. And you're not actually seeing that yet in terms of prices paid for real estate, because in a real estate market, you might not get a transaction. The seller still thinking, oh, well, the price is what it was a few months ago before this mess started. The buyer says, no way, it's a lower price. So you have this big, what you call bid-ask spread. Is just there's no meeting of the minds here, so no one's signing on the dotted line. So until that happens, we don't get real clarity with regard to where prices are in the commercial real estate market. Very different than a stock market or a bond market where it's transacting all the time. It's a very liquid market, and you get price discovery very quickly. You don't see that in the CRE market. Did I get that roughly right?
Yeah, I'd like to take you to investor meetings.
Oh, there you go. Okay, I got a job.
It's real English.
Yeah, that makes a lot of sense. So it all Ryan, goes back to, it feels like, the Fed, and maybe you can give us a sense of your interpretation of the Fed meeting that happened this past week, and what they're saying to us, what the Fed's saying to us, and then I want to go next to long-term interest rates, because that's been pretty dramatic in the last few days, and I want to talk about that a little bit. And that obviously matters a lot for pricing all assets, including office buildings and other commercial real estate. So what's your take on the Fed meeting?
So all the turmoil in financial markets started after the Fed meeting, and the takeaway from the September meeting, as Cris alluded to, like the increase in the target Fed funds rate by 75 basis points wasn't surprising. They barely tweaked the statement, so nothing surprising there. It was the summary of economic projections where the Fed submits, each participant submits their forecast for GDP, unemployment, inflation, and policy rate. So the so-called dot plot. And that was a significant increase between the last time they updated, which I think was in June. So they're now signaling, the terminal Fed funds rate, where it's going to peak this cycle, where they're going to most likely stop tightening, is 4.6%. That's much higher than what the market was anticipating. They were thinking, 4%. It's almost more than a full percentage point higher than what's in our September baseline. So the Fed is just basically, the takeaway, and if reading between the lines and the tea leaves, is they'll stomach a recession if it brings inflation down. And that's the general takeaway. If you look at their forecasts, if the unemployment rate increases by 60 basis points between this year and next year, and as Cris has pointed out, that's always coincided with a recession. So basically, the Fed is signaling we're likely going to go into a recession, and that's really affecting market sentiment.
Yeah. So I that all makes sense. I mean, likely, or it feels like it's like right on the line.
We're going to flirt with one.
We're going to flirt.
It's going to be uncomfortable, and that's what the Fed. That's what Powell's been saying. He's like, this is going to cause pain.
Right.
They're going to, if inflation doesn't come down, they're going to inflict more pain. They are laser focused on bringing inflation down at any cost.
Right. And so what's happening now is that stock investors are digesting that recession now, or really a really tough economy is much more likely. The Fed's going to live with that and to get inflation in, and therefore we're seeing all this red on our screens right now.
Yeah, basically what the market is saying is that there's still a path to a soft landing, and a soft landing is when the Fed brings inflation back down to target. We avoid a recession, so that's kind of like the best case scenario. That path is narrow, and getting narrower and narrower after each FOMC meeting.
Yeah. Okay. I will point out that with even right now, I'm looking at the decline in the market. I think we're down a couple percentage points from where we were yesterday. We're still only down 20, but we're down 22% from the all-time high that was hit back at the beginning of the year, and that's kind of also sort of consistent with recession, but not quite, right? It's kind of like right on the line, because if it were a recession, we'd probably be down closer to 30%. Is that fair to say?
Yeah, I think that's fair. Your favorite indicator, the yield curve, the difference between the 10-year and the 2-year, is among the most inverted since Volcker. So and it's been inverted for a long time. And so if you're a yield curve believer, that's pretty much sending a very strong signal that the bond market.
That's why I've been more focused, as you know, Ryan.
You're shifting, you're moving the goalpost here.
On the other yield curve, the 10-year versus the Fed funds rate, the policy yield curve, which has not inverted.
It has not.
And this gets to my next question to you, and it goes back to cap rates and pricing in the real estate market. The 10-year yield. Have you noticed what's been going on there in the last couple of days? The 10-year, it's going
through the
straight
roof.
up. I mean, I'm looking at it now. It's at 3.7%, right? So
if you decompose it into the three components, which is inflation expectations, long run inflation expectations, they haven't budged. It's the expected path of the real Fed funds rate. That adjustment occurred after the FOMC meeting when they signaled, basically the bond market's taking the Fed at its word and saying that the terminal rate's going to be 4.6, if not higher, because there's 5 or 6 Fed officials that were saying that their dots are even higher than 4.6. So, some have been arguing we might have to get up to 5. So it's really, I think the market's trying to assess where's the ceiling on the Fed funds rate this cycle.
One other thing I'll throw in the mix. I was just talking to a really good bond trader. He pointed out that the Japanese they're intervening in markets, right?
Mhm.
You saw that, right? They're trying to defend
Yesterday.
the yen because the value of the yen is fallen through the floor here, which I find a little bit perplexing. Why they feel that's a big deal, given they've been trying to get inflation up anyway. But regardless, and that means that the Japanese are selling treasury, buying yen in that effort, and that's one of the reasons why we're seeing what we're seeing in the long term bond market. I thought that
Yeah,
was
I mean, that
interesting.
most likely is going to show up in the term premium, which
Yeah,
is
that would be
another
in the term
component of the
premium.
10-year. Yep.
Yeah.
Yeah.
Hey,
But I mean,
Victor.
this week, there's a lot of central banks made decisions. The Bank of England, a number of central banks in Asia, and everyone's being pretty aggressive, but interest rate differentials or real interest rate differentials are strongly in favor of the US. And that's why the dollar is not just against the yen, it's against almost everything. It's just appreciating very, very quickly.
Right. Hey, Victor, you must watch the bond market here pretty carefully because going back to cap rates and valuation pricing in the CRE market, do you have a take on what's driving this? I mean, obviously the Fed's on the warpath and that's contributing, but it feels like long-term rates are rising faster than you would have expected, even given that. But is that your interpretation? Do you have some view on what's going on there?
I mean, I agree with everything that's been said so far about the underlying drivers, but if we bring it back to how that might map out into our cap rates and our cap rate projections for commercial real estate, is that I do think that, Janice, keep me honest here, January and February, we were still kind of hopeful that though we were anticipating interest rate increases from the part of the Fed, that cap rates would at least absorb it from a spread point of view, as long as 10-year treasuries did not rise as quickly as they ended up doing. So there was, I know there are some property types and some geographic markets where cap rates have trended very, very low, just pretty much correlated with where interest rates were going, but there was still a little bit of a spread. But now, as it turns out, if we're using the 10-year treasury as your risk-free rate for a lot of 10-year hold periods for assets like multifamily and office, where you're looking at very, very little spread, and you got a lot of asset classes that have been trading at 4 or 5% caps or below, where there's nothing. And now that upward pressure in cap rates will really likely result in an interesting situation between buyers and sellers, where they go, yep. Janice, what do you think?
Yeah, but I mean, but you hit the nail on the head there. The issue really is, with all this volatility, the people who aren't trading this bid-ask spread, it's not that all of them are in denial, right? Like a lot of them are thinking, hey, the Fed's going to get inflation under control and then things are going to restabilize, the curve's inverted. So, maybe like long-term rates will be lower. So they're just saying, I will either buy cash and finance it later, right? Or I will hold on because I don't want to mark to market, at a very high borrowing cost. So maybe I'll wait a year, maybe I'll wait 2 years, kind of. So that bid ask spread isn't necessarily like, no, I can't hear you, I know rates are higher, I refuse to acknowledge it. It's, what's the best thing for my portfolio? And maybe it's just, buckle up
Holding
and
on.
wait a bit.
Yeah.
And that, I think that is part of what complicates this particular asset class, right? It's an income generating asset class. And as Janice noted, for multifamily warehouse distribution, sure, office kind of on the ropes along with retail, but for multifamily and warehouse distribution, they haven't gotten the memo that there's all this volatility. You've got a good amount of rent growth, decent occupancy. I do know that there are some kind of headwinds in the horizon. Amazon's out there basically saying they're going to sublease a bunch of their warehouse. I'm not saying everything's peachy, but by and large, at least through the second quarter, and we're processing third quarter data soon, rents and vacancies are holding steady.
We'll come back to that. And just one other sidebar to get the listener to catch up if they aren't following along. We're throwing around the word cap rate, capitalization rate. That's short for capitalization rate. And that's simply a discount rate. So just think about the price of the real estate. That's equal to the stream of rents that are produced by that real estate. That's what Victor's calling the income stream. And then you just divide by the discount rate. So, if cap rates are low and falling, all else being equal, with that rent stream, that means prices are going higher, that kind of thing. So lower cap rates synonymous with higher prices relative to rent growth. There's a couple other things I wanted to explore before we move on more in depth into the CRE market. And I'm going to turn back to you, Cris, is around mortgage rates. And, we've been having this discussion around mortgage rates. Now I'm talking about not commercial mortgage rates, residential mortgage rates for a single family home. And last I looked, and I didn't look today, I'm kind of scared to look, to tell you the truth, but
I'll look it up for you.
oh, please don't. I think it was 6.4%, or I think that's what I saw yesterday. Low, of course, was the low point, record low back a little over a year ago was 2.6, 2.65. So they've come up a lot. But the mortgage rate, that 6.4, has risen even more than the long-term treasury yields. The 10 years up a lot. We just talked about that, but even mortgage up even more than that, which obviously is doing a lot of damage to the single-family market, I guess to some degree to the benefit of the multifamily market. But Cris, do you want to explain what's going on there? Why is that mortgage rate going up so much more than at least historical norms compared to like a 10-year treasury yield than has been the case historically?
Yeah, it's a bit, I just looked it up here. Google says 7%. So it's
But you're looking at the wrong one, man. That I look at Mortgage News. Is it Mortgage News? That I think this, we should look. I'll look it up while
anyway,
you tell me what's going on.
it's going north here. It's it's rising, and I think it's endemic of the there are several components here. One is just the volatility in the market today, right? So rates themselves, if you look at MBS or mortgage-backed securities, right? At the end of the day, the price is set by supply and demand factors. So if the rate's going up, it means that you have more limited demand out there relative to a certain level of supply, right? So I think that's a fundamental reason. But then why is that the case? Well, you have issues around the prepayment option that mortgage borrowers have when they borrow money, and at these higher levels, perhaps there's a higher chance of prepayment in the future. So the MBS investor has to account for that. You have that volatility I mentioned, right? So clearly, in these times of extreme movements, it's the investors also have to account for that in bidding up the spread. So I think those are the main components that we have here. And it's just a weird time in terms of the yield curve inversion. A lot of the models, are going to produce results that require or suggest that we need higher yield in order to make the math work here. So I attribute this excess spread that we're seeing between the MBS or between the mortgage rate that borrowers are paying and the 10-year treasury due to these really large these movements in the markets themselves, these dislocations in the markets.
Yes, I looked. The where I go, my go-to for mortgage rates, real-time mortgage rates, is Mortgage News Daily. It's a website, and everything has a blemish to it, but I mean, I think this is a pretty good place to go. 6.62 as of today, right? As of a minute ago, 6.62%.
Headed towards 7.
Yeah, headed towards 7, right? And of course, hard to argue with Google. The one thing that makes me a little nervous about the mortgage rate and this argument that it's based on volatility in interest rates, which I think you did a pretty good job of explaining it. No reason to go down that path again, because I'm not going to explain it any better. It's very complicated, but in a bond market world, it doesn't feel like that's going to go away, that volatility and those high mortgage rates, until the Fed's no longer on the warpath here. As long as the Fed's on the warpath, and there's a lot of uncertainty with regard to where that ends, how high are they going to push short-term interest rates and how long are they going to keep them there? That volatility is going to remain in the market. As long as that volatility remains in the market, mortgage rates are going to remain very high. Would you agree with that?
I would. And then if you throw in the mix, the quantitative tightening, right, with the Fed not purchasing mortgage-backed securities anymore, right? That's at least one source of demand that's no longer there, right? Even if they're not selling actively, they're not supporting that market either. So there are a number of things like probably we'd see the spreads widening out even without this latest bout of volatility. This is just an accelerator.
Yeah.
Well, hopefully with the increase, the Fed doesn't opt to sell MBS.
No, they
were
won't.
just
No,
hopefully
Imagine that.
Right.
Yeah.
they were talking about it.
No,
Well,
but
never
Powell
say
was pretty
never, right?
explicit. I thought he was pretty explicit at in the press conference after the meeting.
Oh yeah. Yeah. I
Yeah.
think now
Yeah.
it's less
Yeah.
likely.
Yeah.
You know,
Okay.
that's great for the multifamily market. I mean,
Yeah.
even before the rate hike, when we cover 50 markets, and then we do a comparison between, is it cheaper to rent or is it cheaper to own? And before the rate increases started, it was cheaper to rent in, 20% of the markets. And then when rates started to go up, it became cheaper to rent in 66% of the markets, right? And with this, you're just
Yeah.
pushing that number up, which is, kind of actually very good for the fundamentals of the multifamily investment market.
Which is saying a lot given how strong rent growth's been, right?
Yeah.
I mean,
Yeah.
geez, Louise. We're going to lose Ryan in not too long from now. So before we lose him, two things. One, a question to you, and then I want to play the statistics game, and then we're going to dive into CRE in more detail. Financial conditions. So the link between what the Federal Reserve is doing with regard to interest rates and the impact on the economy runs through financial markets and the financial system more broadly. We talked about stock prices. We talked about long-term interest rates. I think we alluded to the value of the dollar. It's very strong. Credit spreads in the bond market. Given the sell-off in markets, which represents a tightening in financial conditions, meaning it's going to weigh on the economy more significantly, do you think markets are now where they need to be to slow the economy sufficiently to bring inflation in, or is there more to go here in terms of the tightening that needs to occur?
I think there's a little bit more to go. Not too much, just a little bit. And it affects the economy with a lag. So the tightening that we're experiencing today may not necessarily affect the economy until sometime next year. But past tightening, I mean, there's been a lot of tightening in financial market conditions. It's going to weigh on the economy in the first half of next year. And that's what the Fed wants. They want the economy to be growing below its potential, roughly 2%, 2.5%. So they want GDP growth persistently below that threshold to cool off the labor market, take some heat off wage pressures, and then by extension, that should help bring down some of the inflation that we're experiencing.
Okay. All right. Let's play the game. The statistics game. We each provide a statistic. The rest of the group tries to figure that out through questions and clues, deductive reasoning. The best statistic is one where it's not so easy we get it, slam dunk, not too hard that we never get it. Although that's pretty tough to do. If you can thread that needle, you're really good at this game. And if it's relevant to the topic at hand, that's even better. Or relevant to goes to a relevant statistic, something out there in the recent environment. I'm going to go easy on the guess at first. I'll turn to you and see if you want to play. But just so you see how the game is done, I'll go to Ryan first. Ryan, you want to go first?
All right, I got two for you, and they're related: 355,000 annualized and 55%.
355,000. I want to say job growth for the month of August, but it was 315,000, so it's not job growth. Is this job related?
It is not job related.
Some construction number,
We're getting closer.
permits, or
Getting warmer.
355.
Besides permits, what else is there?
Oh, there's
Starts.
starts.
There's starts. Okay, 355,000.
But
you're getting close.
that's not seasonal. Well, you said annualized, 355,000. Oh, is that permits for multifamily?
It is
No.
not permits.
No.
Starts for multifamily. Is that
Okay.
right?
But
Was that? Oh, okay.
gotta go deeper. Gotta go a little deeper. This is the highest since 1985.
Oh, this is 4+ or 5+ units or something.
Or
5+
20
units.
plus.
Mm-mm.
No. Okay.
Mark, what's our bread and butter?
Bread and butter.
Regional.
Oh, regional.
Oh.
Right.
Here you go. You got it.
Yeah. Okay.
All right, so what region is it?
okay. The West.
Nope.
South. Northeast. Midwest.
There's only 4, so we'll get there. It's
Uh,
multifamily starts in the South. It's the most since 1985, and they account
Oh.
for 55% of all multifamily starts, which is roughly, they're usually between 50 and 60%. But that's a lot of starts, multifamily starts in the South.
Yeah. Your point being, we're getting a lot of multifamily construction.
Yes.
Yeah.
So overall, housing starts unexpectedly increased in August, and it was mostly because of the
It's
volatility
multi.
in multifamily. But it was all multifamily.
Yeah.
And the rent growth, right? It was 12% rent growth last year.
Yeah. I mean, even with all that construction, we still have like pretty close to record low vacancy, right?
Mhm.
Yep.
And, and as you point out, rent growth is double digit. So you could argue we need even more multifamily. I would
Yeah,
think.
the chain of causality may well be strong rent growth, low vacancies, developers responding, just like that Kevin Costner movie, right? If you build it, they're going to come because low vacancies and high rent growth.
Yeah.
You
what was
lost
that
Mark on
movie?
that one. He has no idea.
No. That's one of my favorite movies. The Natural. No, that's
Over-
not-
Field
over
of Dream.
one.
Field of Dream.
Ryan's right. Yeah.
No, I
I'm
knew
just
for
not part of the pop culture. But I like that movie. I like The Natural better than I like
The Natural's a
Field of
great movie.
Dreams.
Yeah.
Isn't it? That's a good movie. Except when he starts bleeding at the end. Remember it showed
Mhm.
through.
And-
his
but
suit.
he hits the home run.
Yeah, I know, but it made no sense that the internal bleeding would be. Anyway, we're getting off track. But that was a good statistic. That was a really good one. Even though no cowbells with that one. And I should say, guys, if you show yourself admirably here and if you get the statistic, you get a cowbell. Well, we've got cowbells. Yep, absolutely. They're pretty cool. All right, Victor, you want to play?
Sure, absolutely.
Okay, you fire away.
I have a number for you. 102.3%. The first time this number crossed 100% since the COVID pandemic began.
TSA traffic Labor Day.
That's exactly right.
Oh.
September
my
3.
Gosh,
I deserve a cowbell.
that is definitely a cowbell.
That's awesome.
That is
Exactly right.
huge. Oh my
That's-
gosh,
Oh,
There was no
That's,
hesitation.
there was not even a
that's-
hesitation.
no, none.
It was big, right? I mean, Janice,
It was
we
big.
were all agog
Okay.
about this, and yeah.
Collusion. I feel collusion.
Yeah, that's close to it. That's an investigation.
I was just
You guys-
going through all of the, kind of the habits that we've returned to post-pandemic
Right.
versus kind of like what's happening in the office market. And that was one of the metrics I was looking at.
So cool. That is one. So we're back above people who go through TSA. The number of people who go through TSA pre-check
Yeah.
is now higher, a bit higher than it was at this point in the year.
Well,
just
that,
prior to
that-
the
yeah,
pandemic.
well, that was the number for September 3. Now
Yeah, it was
okay.
Labor Day. Yeah.
it
Oh, Labor Day.
oscillates,
Yeah.
but we're still at around 98, 97% after that,
Okay.
which, you know what, I'll take it, right?
Yeah,
It's been
right.
going up and down because of all the variants, but it was the first time we crossed 100%.
That
since
is
the
And-
pandemic
really
began.
cool.
And it's consistent with, kind of also restaurant activity and everything.
Mhm.
All of these things are now above pre-pandemic levels.
Yeah. We're back. Yeah.
We're back.
You're back. We got to talk about remote work, which we'll definitely come back to because I don't think we're quite back there yet. But you're saying, what about business travel? Is that back? Is that one? Is that mean?
The TSA doesn't really disaggregate that,
No,
and
but your sense
yeah.
is that mostly tourism is stronger than
I
it was? and-
suspect it's mostly leisure travel. Janice,
leisure.
you tell me. And we were getting less conferences canceled now as opposed to last January. I remember one of my guys went to the CREFC conference in Miami in January, and I told him it was a small miracle that only 3 of them got COVID. Back then, like conferences were still being canceled. Now, not so much, right? Everybody's pushing through with it. There are protocols, but
Yeah, now there is more business travel. I mean, I'm on the board of AFIRE, Association of Foreign Investors in Real Estate, and we had our largest conference since pre-COVID. But I think it's really individual. Like I called, people I work with, and investors, brokers. In August, I got international ringtones like every time I called someone in August, right? So
Mhm.
I think there's revenge travel. It's lots of people vacationing. The euro looks great.
Yep. Yeah, makes sense.
So the Moody's back to normal index though is not back to, I think it's
No.
a 91.
Yeah.
Ryan, do
Well-
you have a sense of why? Is it the mobility piece?
I think it's the
They're not back to
mobility.
the office.
Mhm.
Okay.
Yeah.
We construct this index called the Back to Normal Index. It's a compilation of a lot of different statistics, some of which you TSA pre-check, restaurant bookings, box office, that kind of thing, in economic statistics, and it's still sitting 95%
think it's 91.
of normal.
Yeah.
91, right? It's
Mhm.
91. I think it's three things, Chris. One, we have our own business survey, business confidence survey,
Oh, that's a good point.
and that has been weak.
Yes.
Stabilized recently, but it's weak. Second thing is we use Ryan's GDP tracker. So what is our estimate of GDP growth in the current quarter? And GDP has been weak. It fell in the first half of the year, so that's also contributing it. There's a third reason. The mobility. The
Yeah.
mobility.
Mobility, yeah.
Yeah, the mobility. That's weird. That's the Google mobility. They track people's moves based on cell phone movements, and they break that down into that related to office or retail or transit stations, all kinds of different breakouts. And some of the mobility has recovered, but a lot of it hasn't. It's still well
Mhm.
below pre-pandemic. So it's really odd. In that
Yeah, I think public transit is still way down.
Yeah.
Yeah, public transit's way down. Office is down, still way down. Yeah,
Certainly. Yeah.
right. You want to take Janice? Did you want to go? Do you want to?
Sure.
You have
Sure.
fire away.
What the heck? Okay, so 120% of pre-COVID levels.
Okay.
This open table?
No, but it's a little north of 100, but it's not open table. It's more specifically real estate. More specifically real estate.
Oh, okay. Interesting.
Hotel ADRs.
No, that's interesting.
Actually, it's higher.
Traffic through Times Square.
It has to do with investors.
Oh, investors. And it's a positive thing that it's 120%.
It's a positive thing.
It's a positive thing. And is it investors, global investors in commercial real estate?
Yes.
Yes. Okay. It could be something like the amount of. I hesitate to say it because it doesn't feel like it's right, but something like the dollar amount invested in U.S. commercial real estate.
So you're getting close. So it
Okay.
is about the dollar amount and investing in commercial real estate, but it's not has been
In-
invested.
That has
Oh.
been invested.
It's not
I-
has been.
I'm
It's-
sorry.
It's
Oh,
been
dry
committed
powder.
or it's in a fund.
Dry powder.
Oh,
Dry
dry
powder.
powder. Oh.
So-
I see.
So even though we said that transactions were kind of down 40% in August,
Right.
the dry powder number is 120% of pre-COVID levels, which
Got it.
shows an incredible amount of capital on the sidelines, kind of waiting for this to sort itself out.
Okay, that makes perfect sense. Yeah, perfect sense. So you're saying as soon as things look like the Fed's over, the coast is clear, we're on the other side of whatever it is we're in the middle of, there's a lot of money on the sidelines that could come in pretty quickly here. Yeah. Another reason why sellers don't want to sell, probably.
Exactly.
Yeah, right.
Yeah.
They're saying, I'm just going to wait for that pot of money to come in at some point. Yeah. Okay. All right, let's do one more. Chris, you're up.
Yep. 873,000.
Does it
That's
come from housing starts?
completions. No, that's the number of homes in the pipeline, right, to go into completion.
What kind of homes?
Multifamily homes.
Not started?
Multi.
There you
Good
go.
job.
That's multi.
Yeah.
Yep.
That's
Very good.
multi.
870,000 are under
Yeah.
construction, right?
Yeah. And that's up, but the single family, I think, homes in the pipeline going to completion is actually starting to come off here pretty quickly, I think.
That's right.
Yeah.
But 873,000 is
That's a lot.
is a record high since 1973, right?
Yeah.
So
Wow.
Yeah.
that's a lot that could come online and help fill some of this this deficit that Victor mentioned. So,
Yeah. I guess one benefit of people losing their jobs in single family construction sites is they can walk across the street and go work for a multifamily developer and get some of those homes
Yep.
completed.
Yep.
Yeah.
although the permits are down, right? So
True. Yeah. All right.
And
Well, that was good.
You
we
don't
should
have
move
one?
on, right? Yeah. Do you want mine? I mean,
Yeah,
of course we want yours.
We
You
got a few
really?
minutes. Yeah.
you really want mine? Okay. Hold on one second.
No, he's got to look one
I
up.
got to check. I got to check what it is right now.
Copper prices,
Yeah, I was about to say it.
No, it's not copper prices. How rude.
$435.
1.09. 1.09. And
So is that the
I gave
dollar?
you a big hint.
Oh,
I gave you a
UK
big
dollar?
hint. It's
pound.
Dollar against the euro
You got it. You got the pound. It's the pound.
or the pound. Okay.
Yeah. There's one pound, British pound, buys $1 in, actually at this point, 8.8 cents, 1.088. Has anyone
I've
lived
never
in a
seen that.
time when the pound
don't
dollar has
remember that
been
at
close
all.
to
Yeah.
parity?
Mm-mm.
I
Yeah,
can't
it was
remember.
in the like 82, 82.
Did it get that when the
I
pound
think
crashed?
it was just about pound parity, right?
Yeah,
Pound
that's
dollar
when
parity.
Soros made all his money, I think, on that crash, in the pound. That just, and that obviously goes to the fact that while the U.S., our economy is struggling, the European economy and specifically the UK economy is really, really struggling. I mean, the
Mhm.
recession seems very likely there at some point. And of course, they just got a new prime minister who passed a piece of legislation, or is in the process, I guess, of passing the legislation to cap the energy costs for households because they've been going skyward because Europe relies very heavily on Russian energy, and that's been cut off to a large degree and caused prices to go north. So, very understandable, right? Because low-income households are just getting completely hammered. But the complication of that is it's kind of fueling the inflation fire, right? And potentially exacerbating the inflation, making it more entrenched and raising the odds that the British are going to get in some kind of stagflation scenario with persistently high inflation and ultimately a very weak economy. So that's why investors, I think, in the foreign exchange markets are really having a lot of difficulty with this anyway. But the dollar's up against all the currencies. I mentioned the yen. It's actually beyond parity against the euro. It's 0.969 against the euro. So the dollar is now stronger than the euro. And, against all currencies, it's up quite strongly. Against Canadian dollar, the Aussie dollar, it's about 70 cents. So very, very significant. Okay, let's turn to more specifically to the commercial real estate market. And Ryan just signed off. I think he has some child responsibilities. And let's talk. Maybe we can talk about the multifamily market first, because I think, and I guess to some degree, the industrial market. Those are the markets where I guess the fundamentals are better, and I guess investors are still engaged. Would that be fair to say, Janice? Is that reasonable statement?
Yeah, I mean, so the basic issue with the multifamily market, unlike with industrial or office, is you get to reset your rents every year, right? So to the extent that people are worried about inflation, and even if cap rates are going up, if you can reset your income and if your income is in some sense indexed to inflation, it protects you against what's happening with borrowing rates, et cetera. I would say that is in general, and it's kind of really favored the multifamily market, but it also, it doesn't really reflect, I think, what's happening socially. And what we had during COVID is, a big social backlash against, kind of the discrepancy between rich and poor and all of these kind of social issues. So we have started to see rent control, kind of support across a number of markets, and we don't know how it's all going to work out. So while you do have kind of today the ability to index your income up as inflation goes up, there are emerging, kind of pressures, to kind of cap in some sense. We said average rent growth was 12%, last year. And that's on average, it's 20% in some markets. So there is, emerging pressure to say enough's enough. Let's, kind of put a cap on individual rent growth in markets.
Now, to be fair, just for historical context, before COVID came along, the big news in 2019 was that 4 states were enacting some form of rent regulation. I remember a candidate in New York State running off of a platform saying the rent's just too dang high, right? So it's always been affordability, I think, has always been and will continue to be an issue. I think from an income point of view for multifamily investors, it's been a great year. Janice, we have effective rent growth of 12.7% in 2021, a record quarter in the third quarter. Very impressive. But to your point, these are the headwinds where there are backlashes where we go, you know what? This year, we're maybe at a 5.5% year to date, middle half. We're probably forecasting between 6.5% and 7%, suggesting that the latter half will encounter a bit more bumps in the road.
You said we're going from double-digit rent growth to about half that.
Well, 12.7% to around 7+%. Those are our numbers. And with that said, I'm not crying a river for multifamily landlords if they can eke out the 7+% rent growth for 2022, given how this year has progressed.
Yeah, and I also think kind of the double-digit rent growth in 2021 kind of doesn't reflect the fact that in 2020 it was frozen, right? So, it really wasn't, kind of 12% on top of 6%. It was like 12% on top of effectively zero.
Yeah, in 2020, we recorded some record drops in effective rents for
New York,
like San Francisco, Washington, D.C. had a record drop for the 40 years or so we've been tracking this data. So yeah, it's coming off of a bit of a low.
But to your point, Janice, about the pushback here and the prospects of rent control, I was at a national multifamily housing council, I believe,
couple of weeks ago, right, Mark? Yep.
Yeah, and I were you there, Victor? I might have missed.
I couldn't make it, but Kim Betancourt from Fannie Mae says hi. She missed dinner with you because she was a little bit under the weather.
Kim. I missed her. But anyway, it was first thing I noticed was how packed it was. I mean, the ballroom was overflowing, so business is good. Second thing is they had a group of protesters outside, very vocal, complaining, because these are landlords, right? Big landlords, institutional investors, and they're angry. As you can imagine, they can't pay their rent, especially if they have to pay a rent increase of 12.7%. For most people, that's just like out of bounds. So
and Mark, I'd love to like make that concrete, right? We talk about changes, but Janice, you mentioned that in some markets and neighborhoods, that's 20+%. I had our researchers sharpen their pencils when we were about to publish that the Brooklyn submarket was going to pull the 25% rent growth in 2021. Wow. And how it translated to one of my staff members, she's left Moody since then. I'm not sure if it's causal, but her $3,000 one bedroom was going to get a rent increase of $700. Right? That's 23.3% in Brooklyn. It was real.
Yeah, and you know what I think, Victor? I don't know that I even introduced you guys appropriately. Did I, Chris? I think I just kept on going because I just feel so like we know each other so well. I never really introduced you. So we've been talking all this time. People might be saying, "Well, who are these guys?" And although in the real estate world you're very well known, but Victor is part of Moody's Analytics in our commercial real estate group. And Janice is did I mention Cushman Wakefield, one of the biggest, well, how would you describe Cushman Wakefield? Just massive real estate company. You're into everything.
Massive real estate services firm. So we do everything, office, multifamily, industrial, rent, sell. If it has something to do with real estate, we'll do it.
Yeah. You got your fingers in all the pies and all over the world. As I mentioned earlier, you're all over the world. So I apologize for that. I just took it for granted because we're buddies, so I didn't even think about it. I do that to Chris all the time. I'm sure I didn't even say you were the deputy chief economist.
I don't even know if you said my name. Yeah,
I don't even know if I said your name at this point. Okay, so can we go back to the rent a little bit? Because for a macroeconomist, this is really important because rents drive the cost of housing, particularly as measured in the consumer price index, the measure of inflation that we all look at. It's a third of that index, and it all goes back to rent. So if rents are rising very rapidly, and 12.7% is like out of bounds rapid, that adds to housing costs, adds to the inflation picture. So it's really important to getting inflation down and stopping the Fed and ending the Fed's rate hikes, that we get rent growth rolling over, starting to slow here. So, Janice, do you have a view on rent growth in the multifamily market? I mean, have we passed the peak in rent growth and starting?
Yeah, I mean, so we definitely think we're not getting another 12.7% year. I mean, there are a lot of starts, but structurally we've undersupplied this sector for like more than 20 years. So kind of the pressures that we have are because you get to markets with 3%. Kind of vacancy rates, and we've undersupplied them. So we think with the amount of starts, and we focused a lot on starts that we have coming online, it's going to take some of the pressure off, and that rent growth will kind of moderate and taper, which I think is a good thing.
Yeah. And Victor, you said 6%. Did you give a date? I mean, you're probably like those good forecasters that I know. You give a forecast without a date. I think.
Yes.
Yeah. I don't think he gave me a date. Chris, did he give me a date?
I didn't hear it.
I didn't hear a date. So 6% by when? Is that like by this time next year?
We're looking at 6 to 7% expected for all of calendar year 2022.
2022.
Oh, this
Yes.
year.
Oh,
Yes.
okay.
Yep.
Okay. Can I ask then, roughly speaking, what does 2023 look like next year in terms of rent growth?
Around, we're looking at half that.
Oh,
thereabouts.
okay.
Yeah.
Oh, okay. That's very encouraging.
So, well, there's that moderation, but I will let you know that given the data that we've tracked and how some clients have used it to predict shelter inflation, there is about a 2 to 3/4 lag. And so what we're seeing hit the CPI numbers was, Janice, it's probably that 12% that we recorded in 2021, right about now. And so hopefully relief is on the horizon, hopefully starting next quarter, but we'll see. We'll see.
Okay. Okay. So you're saying calendar year 2022, we're going to be at 6-7%, which means we're ending the year on a pretty soft note compared to the start of the year. We came roaring into the year, double-digit rent growth. We're leaving the year, feels like low single-digit growth to get to 6.67% for the calendar year.
Yeah, the second half in particular, we are expecting a bit of a slowdown, and it could be reduced to the 3 factors, less of that in migration to former Zoom towns that characterize pretty strong demand at that point, and then slower household formation and just the affordability issue that we've discussed.
Which creates demand destruction. Households can't form, and they can't afford they can't afford to buy a single family home. They can't afford the rent now, so they have to stay with their parents or
and it's somewhat disingenuous to just go and say I'm always optimistic because someone needs a place to live, but it also means you could go back to your parents' basement, which they preserved for you exactly when you were 8 years old, right?
Yeah. Hey, Janice, in terms of capital flows, is it still? You said that investors have gone to the sidelines. Does that also apply to the multifamily market?
There's much more demand for multifamily. Multifamily and actually debt today because rates are higher. There's a very kind of strong bid for that. It's seen, kind of at this point in the cycle, it's a little bit of a cushion against what might happen with recession, especially kind of mid-market assets, workforce housing. But definitely multifamily in general has bucked the trend. And it's probably, we used to call it beds and sheds, anything with a bed in it, multifamily, anything with shed industrial. Now sheds are somewhat less in demand, but multifamily beds are still like the number one choice for investors.
Got it. Okay. So it feels when you look at the spectrum of commercial real estate, multifamily feels like it's kind of at the top of the heap in terms of the fundamental conditions, vacancy, rent growth, prices, capital flows, all those kind of things. Would it be fair to say kind of at the bottom of the list is kind of the office market, particularly kind of the big office towers sitting in big urban centers, like where you are right now? You're in New York, aren't you, right now?
I'm in New York.
In your office in New York, yeah.
And I think you pegged that accurately. The issue with office today is not only kind of the national vacancy rate, which is, 17+%. It's also this reluctance of employees to go back full time to the office. So, some employers are basically saying, we know we want these guys back. There are 2 job openings for every person looking for a job. So to, kind of push people back to the office doesn't seem, you don't want to be too tough because you don't want to, get a lot of rollover. You don't want the great resignation at your company, right?
Yeah.
So the office sector, I think people, are thinking, wow, it looks like it might be a value investment, but we just, we're not quite sure yet what's happening with workforce flexibility and work from home. So it has not been, the trades have been, at a kind of a relatively low level.
No one's buying,
versus-
no one's selling, nothing. They're just, that bid-ask
I mean,
spread
there-
is very
you know,
wide.
Yeah, the bid-ask spread is wide unless you have something like you're 100 or 95% occupied or 100% occupied long-term credit tenants, sure. That looks pretty bulletproof as long as you can get through the next couple of years. That looks pretty good. But anything with a large amount of vacancy or roll, people are just taking a little bit more of a wait and see attitude. I mean, I personally feel like, there's some value investing to be had here, but it's quite a counter-cyclical.
When you say
kind
value
of
investing,
approach.
you mean prices are going to get to a place where there's real value, even
Yeah,
at,
significantly
yeah.
below replacement cost,
yeah,
right?
right.
But you
Right.
have to, you have to buck the trend for the next year and a half, because vacancy rates, even if everyone comes back to the office, vacancy rates are still structurally quite high now. They are not out of line with what happened after the GFC or the dot-com, right? In terms of, 8 to 9 quarters of negative absorption is completely consistent with what has happened. It just doesn't feel good when you're in it, right?
Yeah.
So, that's what's going on in office.
And also, I think to Janice's point about the uncertainty in the tight labor markets, it is true that in the near term, office is that asset class that has a crosshair target painted on its back, right? If we encounter some kind of recession, I'm just going to bet there are going to be a bunch of CFOs uttering a refrain like, to manage our margins, we're going to let go of underutilized office space and reinvest, retain and reward our people. So let's see.
Yeah,
It's an easy target.
See, that's very interesting because you're saying, kind of like that a recession is kind of bad for office. I think in a weird way, a recession gives employers more leverage to bring people back
Oh.
to the office.
Interesting.
And the reason I say that is because the productivity numbers early in COVID were sky high, right? I mean, people, had to shelter in place. You couldn't go out, you couldn't hang with your friends, you couldn't go to restaurants, you couldn't go shopping. So productivity numbers were really high. But if you look at starting in 2022, the productivity numbers went below trend. And employers started to say, you know what, people in all these polls, Cushman and Wakefield does like a cajillion of these polls about, are you engaged? Are you motivated? There's a 15% gap between if you're in the office 3 or more days a week, you are 15% more likely to be motivated and engaged. So even though you want the flexibility to work from home, if you take the temperature of how you feel, people who are in the office 3+ days a week are more motivated and engaged. So I think employers would like to draw people back to the office. It's just that individuals want the flexibility to work from home. And given the balance of power between employee and employer, they're giving flexibility right now. I mean,
yeah, that's in the near term. I do think there is a centripetal. I always confuse this, right? There is likely, I would claim that in the intermediate term, 3 to 5 years out, that there will likely be a showdown when it comes to, well, you know what? We probably have proximity bias. And if you show up in the office more often than your peer, I wonder if you're going to get promoted faster. And is that going to pull people back to the office? Or is that going to be an HR issue? Because, you want to play like you're the enlightened employer. You're saying it's going to be the same for hybrid and in office. And yet this person in office is advancing faster. Let's see.
I actually think that conversation is starting to happen more on an ad hoc basis, meaning that in the beginning, employers tried to lure people back to the office. They said, we're going to get you the best space. I mean, actually, brand new Class A office space is at a 30% premium to the rest of the market today, and it was 20% pre-COVID. So people are placing more value on the best space. So they're saying, come on in, let's lure you in. We're going to have really awesome space. It's going to be really collaborative. They were doing, kind of food and fun. We're going to have ice
creams on a Tuesday afternoon,
right? Tuesday tacos. Come on in, 15-minute massages at your desk.
What?
But now,
is that right? Are you making that up?
No, this is true. This is not every company.
I don't think Moody's did that, Victor, for us. Did they do that? No, I didn't.
No, I'm thinking that'll run afoul of harassment training and
prevention.
Right.
but funny, but now I think it's moved to the point where everyone's looking at what's going to happen with recession. Conversations are starting to be had, in a kind of mentorship way, saying, people are looking at contingency plans, maybe contingency cuts. It might be good for you to be more visible. So this is exactly what you're talking about, Victor. It's better for you kind of conceptually, right? Because people still have a little bit of an old mindset. I don't know that we've 100% accepted, from an employer perspective, the flex work, the work from home. If there are cuts, I think that if you're less visible, you're a little bit more vulnerable. And I think those conversations are happening.
I just want to point out there's this growing, we talked about this last week on the podcast because we had Nick Bunker from Indeed. It's Indeed.
Indeed. Yep.
Indeed, the job posting. And he's a great economist, and, he follows this remote work dynamic pretty carefully. And he made the point, and I think he's right. There's this gap between what economists think about remote work, that it's productivity enhancing, and what CEOs and business people think, who think it's productivity destroying. Somebody is wrong, and so we'll figure that out going forward. One thing, Janice, you did say in the chatter we had before the podcast, that you travel a lot all over the world, that attitudes towards remote work are very different across the globe. Do you want to describe that? I found that fascinating.
Yeah, so it's interesting. In a lot of countries, they can't understand why the U.S. isn't kind of 100% back. So, I just got back from literally, Singapore, Seoul, Tokyo, Sao Paulo, Brazil, Santiago, Chile, and London, right? And I would say that the U.S. is far behind all of those markets in terms of the return to office. And maybe Austin isn't as far behind because, Austin is one of the markets where, it's on a Wednesday, maybe up towards 70%. But if you go to these markets, South America is 100% back. It's like nothing ever happened. The UK may be a little softer, but it's mostly back. You look around a floor and, most people will be there. Friday might be light, but in the US, our numbers are really hovering at half, a little bit higher, a little bit lower, depending on where you are. And they're better after Labor Day. New York was up 9% after Labor Day, which shows a post-Labor Day push, but still all in, and it shows in office occupancy. It shows in, if you look at, kind of mass transit, subway ridership, bus ridership, kind of around 60%. We have been much slower to get back in the office, and the question among a lot of the international community is, if it's gone on for this long, right? The longer it goes on, the harder it is to revert to mean, right? But none of these other markets, in Tokyo, you'll have a meeting, everyone will be wearing a mask 3 feet from you, and there'll be a plexiglass screen, but they're in the office.
Interesting. And I'm headed that way. I'll be in Tokyo in 2 weeks. I didn't realize I better take my mask with me.
Lots of COVID tests, lots of PCR tests. Get ready.
Apparently, the government just dropped the visa requirement for visits.
Oh, good. Yeah.
Makes it a little easier. Well, I don't want. At this point, we're running out of time, and I thought we could end the conversation in this way, because we are economists, and we are obviously recession is top of mind. From your prism, your perch, looking at the commercial real estate world as you do, does it feel like a recession is coming? Or first of all, or that a recession is there, and that secondly, a recession is coming? And maybe I'll throw in one other question while I'm at it. What is there something you would be looking at, or that you are looking at, to gauge whether it feels like we're going into recession or not, from a CRE perspective? And I'll go to you first, Victor, if you've got a perspective on that.
I do think that from the income driver point of view, commercial real estate always lags the overall economy. It'll follow if and when employers start shedding jobs, in which case there will probably be pretty clear markers of a recession incoming. But with that said, I think the general hope is that even if there's probable volatility on the pricing side, that if it is a relatively shallow recession, fingers crossed, that a lot of these income generating property types, the stuff we talked about today, will weather it just fine. But we will see. And so those are the things we kind of look for. I'd love to see the Q3 numbers for income drivers. I'll leave the rest to Janice when it comes to the capital markets and transaction volume and cap rate stuff. We're not seeing it just yet, Mark. But again, it's a lagging variable.
And just so to make it clear, when you say income drivers, you mean like the
Rents and vacancies.
Rents. Yeah.
Yep.
Yeah.
Yep. Just
And
rents.
you're
and
not
vacancies.
seeing any sign yet of
Well, aside from
stress.
the idiosyncratic stuff, where sure, there are headwinds in industrial because we're buying less goods as we transition
Oh, I
the
see.
economy to spending more in services. That's why you've got like earnings warnings from Target, Amazon, and Walmart, but you've got airlines posting record earnings. And so there is that. And so Amazon subleasing a bunch of their warehouses, they're stopping construction. But there's that. But with that said, is it localized? Is it across asset classes and asset types? We haven't seen it just yet.
What about development? Have you noticed any projects that were kind of early stage and have just gone dormant, or projects that are underway that are being slow walked? Are you sensing any of that happening?
We're seeing more of the difficulty in the construction financing side, I think, just because you've got a lot of lenders also saying, look, do we want to pull back and reevaluate our LTV and our income assumptions? But with that said, we just cited that 873,000 multifamily properties are coming down the pike. I do think that if and when there's a downturn that comes, that's when causality comes, where supply growth slows down, right? That's when once you've got your shovels in the ground, sorry, that apartment building is going to open its doors, even if we run into a recession with lease of velocity slowing. And then we pull back on future deliveries.
What about you, Janice, from your perch? Do you sense any weakening in kind of the environment, both from a real perspective, vacancy, absorption, and from a capital markets perspective?
Yeah, so I agree with Victor that the fundamentals, kind of in multifamily and industrial are kind of so strong that even when you get some headwinds, with the kind of relatively brief recession, they're just headwinds. It's nothing catastrophic, right? I do think though that, and actually Kevin Thorpe at Cushman Wakefield just put out a paper on price adjustment. I think that the fundamentals are different from price adjustment, because I think that your return on equity, given the spike in debt rates, mean that we're going to see upward cap rate movement, even with the fundamentals being pretty decent, right? Because if most people lever, 65 or 75% of acquisitions, and now LTVs are down to 60 to 65%, and your cost of borrowing is up north of 200 basis points, you just can't afford to pay as much for the assets, even if the fundamentals are pretty darn good. So yeah, I think we're looking for, kind of 100, in office. There's a paper that Cushman just published and it breaks it out by property type, but it's as much as 100 basis points cap rate increase.
Yeah.
And what's interesting about that, Janice, right? Mark, you alluded to this earlier, because cap rates have gotten so low over time, that same 100 basis point increase will result in greater value destruction if you're going up from 4 to 5, as opposed to if you were starting up from 7 to 8, right? It's that denominator effect. And so it is concerning if and when it plays out.
Yeah, and the NOIs are moving too, right? Because with inflation and everything, so you get a little bit of offset, but it is an issue. Values will be lower with the cost of debt where it is today.
Yeah. Okay. So, but if you're sitting trying to scan the horizon here for recession, you say, there's reasons to be nervous and worried given what's going on with interest rates and what it means for the cost of capital and what it means ultimately for the price of commercial real estate. But from a kind of a fundamental perspective, demand, vacancy, supply, not yet. You're not seeing anything really.
No,
yet.
Office is softer
Yeah.
than the other property classes for everything that we talked about, or
Yeah.
return to the office. But, the fundamentals are actually quite good. Kind of,
Quite good.
if you look at kind of past recessions and where we started with the fundamentals, they're pretty darn good today. So, we can withstand some of these headwinds, not a problem.
Good. Hey, Cris, I want to just turn it back to you for any last words. You've been listening to this conversation. Anything strike you with regard to the conversation?
No, I generally agree with everything that's been said here. I think just turning back to the multifamily construction numbers, right? I think consistent with what was described is, yeah, we do see this increase in number of properties that are under construction, but we've also seen a decline in actual completions recently, right? So that does suggest kind of that slow walking. Yeah, we're we're building out, but maybe not as speedily as we otherwise could. And then you also do see the pullback on permits, right? So that's also suggesting, hey, some caution there, not really starting new projects at a rapid pace in this environment.
Right. Okay. So your sense is there are some signs that builders, developers are starting to grow more cautious here and maybe kind of reining it in a little bit.
Yeah,
margin,
I mean,
at
still, I think still quite aggressive relative to history. If you go back a
Yeah.
couple years, right?
Yeah.
So there's still
Yeah.
demand. They still sense the demand out there.
Yeah. Yeah.
The other question I haven't really studied closely is the mix. If we're thinking about multifamily in terms of the luxury versus or higher end of the market versus lower end of the market, it looks like it's still targeting kind of the higher end.
The higher end.
Yeah, I'd say, Janice, right? 95% of new, the numbers just don't work because of the high construction costs.
Exactly.
You don't bring in a class A property,
yeah.
right?
Exactly. What you do for mid-market is you renovate the older stuff because it's just too hard to build, right? Without other kind of concessions or support or government support. It's too hard to build with the current cost of construction, to mid-market.
Fun stat for the mix, Class BC vacancies are at 3%. And as of the second quarter, rent growth for Class BC apartment properties actually outpaced those of Class A.
Mhm.
So let's talk about that in terms of the context of affordability and
Yeah.
just overall tightness.
Right. Okay. Well, we've covered a lot of ground, and I think we need to call it a podcast. This is, we could do this all day long, and maybe we'll have you guys back if you're interested in 3, 6, 9 months. You see if there's any more warning signs out there from your perspective on what's going on in CRE and what it means for the broader economy.
We
But
might all be
that's-
back in the office.
Yeah. Yeah. Will you be?
I'm
not
here.
sure I'll be. Yeah, you're there. Yeah,
I'm
you're
here.
there. Yeah. I'm not sure. You can see my not elsewhere classified room back here. So,
I just missed the laundry hip hugger.
Yeah,
behind the
that's right.
bar.
I
That
tried
was
to clean it up a
fantastic.
little bit for you, Victor. Yeah.
Thank you.
But I want to thank you guys for taking the time for a very informative conversation. And with that, we are going to call this a podcast. Take care, everyone.